Hi, and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. October's behind us, and we're here with Jeff's monthly review and outlook for November, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to make sure you stay on top of all of our content as well. Jeff, welcome back.
Hey, thanks for having me, Mehdi. It's great to be back.
So we're on the second day of November, and obviously kicking things off. I'd love to hear your top-down thoughts going into this month.
Yeah, it's interesting. Usually November is quite the opposite of October. That's kind of the old Wall Street maxim. Whatever happens in October, expect the opposite in November. I think it's going to be kind of the same, actually. If you saw the way the market played out in October, we had a pretty decent rally to start off the month of October, and we peaked around the 17th or so, and then we collapsed into the 27th. And so, there was that, up then down movement. We think it's going to be really similar. We think this rally off of last Friday's low is probably, coming near the peak of its upside intensity. And so we would expect this to peter out here sometime very soon, today, maybe tomorrow. Then we'd expect a little bit of a counter trend and then possibly push back up to a slight new high. We don't expect this counter trend advance to push, materially above, say, 42.50. And that's kind of the level that we're looking at, plus or minus, right, is where we think it's going to top out. We then think on or about November 13th, plus or minus 2 days on either side, we think the market will begin to teeter and roll over. We'd be looking for a sharp decline into the end of the month. We've got an important cycle turn date that comes into play on November 27th, and that's where we think the market will bottom for the year, probably around S&P 3,800, and then we expect a year-end rally from there, where maybe the market's got the potential to end the year up around 10% or so, off of maybe levels that are significantly lower from where we're at today. So, yeah, it could be another roller coaster ride. We've got a lot of earnings coming out still. 50 companies report today, including Apple. This could be, have a pretty significant impact on sentiment in the short term. We're seeing a lot of companies that have reported are gapping up 10% this morning. Among those, Roku, a Kathy Wood stock that's been decimated, right? It doesn't take much to move stocks that are trading at very, very low prices up 10%, especially when there's an unexpected announcement or an upside surprise or an upside earnings guide. All these things are having an impact. We'll see. I think yesterday's commentary by the Fed chairman suggests that the Fed may still have one more hike in them, whether or not it comes in December or early in the first quarter of next year. It doesn't necessarily look like these guys are indicating that they're done for good. It looks like they're taking kind of a wait and see data dependent view. And we got a lot of data coming out. We got a jobs number on Friday. We got CPI and PPI coming out on the 14th and 15th. Just after kind of the turn date that I'm thinking about for the market. So these could have a big influence, right? It doesn't look to me like 10-year bond yields have peaked yet. I see one more move up for this cycle. Our target is kind of, the 525.30 range we're zeroing in on right now. And we think that will probably mark the upside move for this kind of stage of the rates advance. So, all these things kind of have us on the sidelines with our asset allocation view from a big picture perspective. Tactically, we've been telling our clients to remain patient, minimize net equity exposure, maximize cash reserves, collect your 5.5% in T-bills. It's the best, it's the fattest pitch you're going to see. And so we're sticking by that.
Time to clip your coupons and keep doing it. So, Jeff, I was going through your monthly piece and started off with like the big picture, the financial crisis chart. Can you run us through this? Because things are looking pretty tenuous here.
Yeah, honestly, this is the first time we've printed that chart since January. We kind of pulled it because, it had moved out of the range where we thought there's really not any imminent danger right here. It's repetitive to just kind of keep showing this in neutral territory. It's taken up space, and my customers are telling me they don't want a 100-page deck anymore. They don't like to read. They want to watch your videos on YouTube, But, we decided to put it back in because we got a signal change at month-end October. And, I kind of got the sense mid-month that was going to happen based on, the model ticking down below the short-term trend line. And so this gave us a negative signal. And what it means basically is, we're taking kind of the ratio of some highly economically sensitive risk assets versus some interest rate proxies, right? And so this ratio, gives us a good sense of liquidity in the markets right now. And when liquidity is strong and trending higher, the market should be strong and trending higher, and that shows up in the model, right? Well, liquidity is tight. Liquidity is getting very, very tight. And I think one of the things that's happening right now is you've got something of a shadow banking crisis developing in China. And this is sucking a lot of global liquidity out of the market. And so this model really affects global markets, not just the US market. And it first made its kind of debut in our work back during the financial crisis. We were just kind of playing around with a bunch of variables, and we're like, whoa, this catches our attention. This is telling us that there is a serious liquidity dearth in the market. And it actually held in that position, that negative realm, up until about, I think, May of 2009, at which point we got a positive signal and got pushed back into the market. So using that as a timing device for the big picture, whether to be long equities or not, it has been beneficial, right? And so we got the first negative signal in March of 2022. This took us out of the market and made us, strategically neutral on equities at the very minimum, right? Things got worse and we got bearish for a while, but as this model moved back into neutral territory, we took a neutral view strategically on equities, and now it's broken down again. So I think, we are officially neutral from a strategic perspective, but we're a hair's breadth from turning bearish, and this model is a leading indicator of that. And so my suspicion is we're going to see more bad news, not a reversal. And as this tends to trend, and if it continues to trend, then I think we're going to have a big problem on our hands a month or two down the road.
Very interesting. It's actually really helpful that you break that down in that way. Thank you for that, Jeff. Can we have a look at the cycle composite? I know we've been following this quite closely as well.
Yeah, I follow the cycle composite. It's aggregated by Ned Davis in this chart. It's a very, just a beautifully done illustration of the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle, equally weighted and aggregated together. And so the solid blue line, light blue line, kind of indicates the expected path of prices for the year, right? And the gold dash line is the actual path of prices. And what we see is that, from a trend perspective, and trend's way more important than level, the market has pretty much tracked the trend of this expected path pretty well. The pullbacks have been deeper. Sometimes the accelerations have been sharper to the upside, but more or less it's moved almost exactly in line. And what we've noted is that there were 2 key lows, one in October and one expected in November in the cycle composite. And we put some vertical lines in here as well. And those vertical lines represent a different set of cycles. These are cycles developed by the late, great Paul McCrae Montgomery. We call them Montgomery cycle turn dates. We've highlighted these dates as going back into September, but here we've got a couple dates in September, a couple in October that have all passed. Most recently, the October 28th cycle turn date marked the low last Friday for the S&P 500. We now expect a counter trend advance to carry prices higher, as they have, into and about or around November 13th, before we see the next leg of the decline kick in which we think will carry down into the final cycle turn date which is slated for November 27th. And that aligns perfectly with the cycle composite, which is expected to post its low also on November 27th, which is a Monday. So, all that being said, we continue to have a cautious outlook for equities throughout November as a result of this data set. We think it's pertinent right now. The market's been in this rhythm, and we think it's going to remain in this rhythm. And then once we do put a low in late November, we think the all clear sign for a year-end rally will kick in, and that's when we will look to reposition tactically for a more aggressive bounce.
So, Jeff, obviously you mentioned that the Fed maintained rates yesterday, but they could still have another hike left in them. Let's have a look at inflation, because obviously they're data dependent. How's inflation looking at this point?
Well, inflation's improved, right? We've seen a decline in the inflation data from its peaks over a year ago, right? And that's the correct trend and interpretation of the data, is that it's improving, right? And that's what we want to see if our outlook is bullish on the market, right? The problem is the rate of change, right? So we've seen a pretty accelerated decline in inflation data throughout the summer months, but it's now kind of stalled out. We're not seeing the same level of improvement month over month that we had been seeing. In fact, if we look at the Fed's internal models, there's actually 9 of them, and there's 9 Federal Reserve banks. I think each Federal Reserve Bank has had some, has their fingerprints on one of these models, and each one of them is designed to calculate or forecast core inflation, right? And what we can see on the right-hand side is circled in red, is where these levels should be if we're on target. And what we see circled in white on the left is actually where they are, right? And so, where we are relative to where we should be is about 260 basis points north of target on average, right? If we aggregate everything up and take it as an equally weighted average. So, the Fed's still got some work to do. And that's why I say, it's not clear, certainly from the Federal Reserve Chairman's commentary, that they're done. They're on hold for a while, and they're looking to see if the data continues to confirm. There is long and variable lags between the impact of monetary policy and the action of monetary policy. And I think that has been, running toward the long end of the normal ranges, probably because the degree, the magnitude of the stimulus that was involved was unprecedented. And so there's really no model to compare it to. Maybe World War II, would be the best sort of model where we had that much economic stimulus from the government, right? And the question is, how long will it take to fully run its course through? Nobody knows for certain, but it's clear that we're getting close to the end if we're not there. And so as the stimulus runs out, then I think the tightening of monetary policy that we've already seen will begin to have, a greater impact, on a relative basis, right? And so it may not be necessary for the Fed to tighten further. And certainly as the Treasury continues to, increase the supply of Treasury bonds to the market, that is going to push up the term premium, which could be doing some of the work for the Fed, and may require them to take less action on the short end. But bear in mind, the Fed is also liquidating their balance sheet, right? They're down to around 8 trillion from 9 trillion. And the goal is to get back down to where they were pre-COVID, which was around 4 trillion. So, they still got to cut that in half. And the original plan was to do it in 3 years. They're a few years into it already. It's not, we're not there. So I think that this will continue to go on for some time. So that is going to continue to be put pressure on interest rates at the long end of the curve.
So if we're not talking about inflation, we're generally talking about recession. And we discussed this on and off over the last several weeks and months as well. What are your thoughts on the recession situation? Are we in one? Are we likely to go into one still? Is it going to be hard, soft landing? What type of stuff? And bringing in the yield curve does it feel like the yield curve is starting to re-steepen, which has always been a historical indicator of recession as well? So, yeah, what are your thoughts, Jeff?
Yeah, it not only feels like we're seeing a re-steepening of the yield curve, but we are seeing a re-steepening of the yield curve. There is just no question about it. The 10-year, 2-year spread uh, widened out to negative 106. I believe that was in about a year ago or so, maybe 13 months ago. And so, we're clearly, tightening that up. That unwinding the inversion, if you will, re-steepening the curve. The inversion is now negative 19 basis points. So, we've unwound that inversion to about 80% of that effect, right? More importantly, the 10-year, 3-year curve, which is what the Fed is a little bit more focused on, that is re-steepened from negative 215 basis points. I think maybe back in April of this year or so is when we got the wides there. That's now re-steepened to I think 71 basis points negative at this point. So we've cut that in half and then some. So this is a very, very sharp re-steepening over a relatively short period of time. I've said this before, the inversion's kind of the shot across the bow that recession's imminent, right? And there's no question that this inversion has been one of the best forecasters of a recession. In fact, it's got a perfect track record over the last 50 years, forecasting the last 5 recessions. But the lead time has been as short as 10 months and as long as 33 months. So very long, very variable lags from this indicator, right? What's interesting to me, though, is that once we get a re-steepening, once the curve begins to re-steepen and unwind that inversion, then we get a much more truncated sort of time period between where we are today and where a recession comes in. And that's usually 6 months. So it's usually once the inversion begins to unwind, it marks about a 6-month clock to recession. And so that began several months ago, right? I think June, July for the 10-year, 2-year spread, and back in April for the 10-30 spread. And so my thinking at this point is that we're likely to see recession begin in the fourth quarter. We had a big GDP print. Real GDP came in up 4.9% in Q3, but most forecasters are looking for something, less than 1% positive in the fourth quarter. Well, Powell yesterday even said, that was a one-time thing. It was kind of an inventory restocking drove GDP growth. Well, if you can't sell that inventory, you're not going to restock again anytime soon. So, I think we replenished a lot of inventory in the third quarter. Most of the supply chain is kind of built up their stores, if you will, and they're shoring up their ability to fulfill orders in case there's another problem, right? Especially with everything that's going on geopolitically, that makes sense, right? And so I don't expect that to happen again in the fourth quarter or the first quarter of next year. And so those 2 quarters, I think we're looking at potentially pretty low GDP prints and possibly negative. In fact, the first quarter oftentimes prints a negative GDP, even when we're in kind of a normalized sort of cyclical, economic cycle, part of the economic cycle.
So, Jeff, can we shift over to some technical levels here? You discussed in your opening statements about your thoughts going towards the end of the month, some negativity there, and then potentially an end-of-year rally. Can we have a look at the short-term Elliott wave analysis and your put some levels to some of this, some meat on the bone?
Yeah, absolutely. So, like I said before, I think we put in a short-term low last Friday on October 27th. Our work says that marks the bottom of minor wave 3 down of a 5-wave impulse pattern that will ultimately be an intermediate wave 1 of primary wave 3 down. So, if we're looking at this chart, the July 27th high marks the top of primary wave 2 up. And, what we're seeing right now, the initial decline of primary wave three. And we won't be able to absolutely confirm that until we see a break of 4,100 in the S&P. So I think the probability is 90% probability at this point, but we won't get a hard confirmation of that until we break 4,100 on the S&P. Once we do break 4,100, that will definitively confirm that primary wave three down is in progress. I believe it is right now. And what we have so far, and I've actually been looking at the count a couple of different ways. This is our preferred count. So we saw the August 18th low was primary wave one down. I'm sorry, minor wave one down of intermediate wave one down of primary wave three. The rally into the September 1st high was minor wave two. And then we have a 5-wave decline into the October 27th low. That's minor wave three. So what's happening right now is minor wave four up, a counter trend advance. Like I said earlier, I think it will probably top below 4250 somewhere around November 13th. And then I think the next leg, minor wave five down, will culminate from there and carry into the next Montgomery cycle turn date around November 27th. That should mark the bottom of intermediate wave one down. We estimate that will terminate on or around S&P 3,800. From that level, we should see a fairly powerful counter trend advance, falling in kind of the year-end rally category. We think it'll top somewhere in the early part of the first quarter of 2024. And then that will mark the top of intermediate wave two, okay? And what level could that be? We think somewhere around 43.25 would be the upside boundary of that. So, if you're long equities and you want to just kind of wait for it, you could wait until middle of the first quarter and probably break even, right? But I think you get out now and you avoid, the decline, because it could be much more powerful than we're thinking, because we have an alternate count. And the alternate count is that the first leg down, the August 18th low, may be marked intermediate wave one down instead of minor wave one down. And if it did, then the September 1st high would have marked intermediate wave two. And so we're already in the midst of intermediate wave three, and that the decline was actually a 1-2-1-2 and not a 5-wave impulse. And so if that's the case, we are on the precipice of a third of a third of a third wave decline. That's a third wave, the most powerful wave in Elliott parlance, at 3 degrees of trend. And we're probably poised to collapse into that November 27th low. So the alternate count is an extremely bearish count. Some people are like, well, your alt should be a bullish count. I don't have a bullish count here. If the market carries above, say, S&P 4,400, I'll have to rethink how I've counted this short term. But I don't think we're going to get there. There's a lot of real estate to cover, and I don't see a lot of reason for it to happen. So, at this point, we continue to be suspicious of the market with a lot of bearish potential ahead.
So, Jeff, that was the short-term breakdown. If we zoom out, anything change on the long-term trend side? Is that still obviously quite negative as well?
Yeah, from a long-term perspective, we have targets of, say, 2250 on the S&P 500 before we see the end of cycle wave A down. As we've been saying for some time, we think the January 4th, 2022 high marked the end of super cycle wave three. And if we're correct about that, then we are in the very early stages of a fourth wave correction at super cycle degree. That could take a decade to completely play out. And so we could be looking at kind of a lost decade for equities, going forward. And so, our big picture view is extremely bearish. And that's one of the reasons that we think T-bills are the best place to be right now. And once we're confirmed, absolutely confirmed, that we're in wave three, primary wave three down, we could look to actually get short the market. And we will when the time comes. It's just we don't have definitive confirmation at this point. And one of the things that I've been, advocating is being patient, right? Because, it doesn't pay to be early when you're shorting the market, right? I'd rather be late and short the market into, the last 20 or 30% down rather than the first 20 or 30% down, because the odds of getting whipsawed are much, much less when you've got that capitulation. And so, we're kind of biding our time here. Like you said, clipping our coupons and T-bills and waiting for the opportunity to short into weakness that's breaking down. Once we take out the October 2022 lows, that will be the trigger point to get short the market, in our opinion.
Well, you just touched on it there with capitulation, but obviously tied to capitulation is momentum. Looking at the long-term momentum model, how is that looking?
Yeah, the long-term momentum model is positive still, but we're showing the S&P cap-weighted index here. The prior chart, I think, showed a view of the trend model, and we're using the equal weight index. I like the equal weight index as a better representation of the S&P 500, the broad equity market, right? But when we're looking at momentum, if we look at just the cap weight index, it continues to hold positive and has ticked up month over month very slightly. The problem is, if we were to look at the equal weight version of this momentum model, it is barely positive, and it wouldn't take much to turn it back below its prior low, which would generate a negative signal and turn the whole case bearish on momentum. So it all depends how you want to look at the market. If you want to look at it on an equal weight basis and look at the breadth of the market, what's the momentum of the broad market? It's pretty weak. If you look at the cap weighted market, which is led by the Magnificent Seven, then you still have, a positive momentum story to tell on a long-term basis. It hasn't broken yet, but in my opinion, it's just a matter of time.
So that's a great point that you bring in, because we've talked about the quality of this rally ad nauseum and the lack of the breadth of this market. Talk to us about the cumulative net new highs. They seem to be even lower than usual.
Well, yeah. So let's look at it this way: new lows in the broad market. If we look at the NYSE and the Nasdaq cumulatively, right? New lows outnumbered new highs last month, 13-1. So the cumulative net new high measure made a new low for this particular bear market cycle, right? And so it's really tough to suggest that the market is in a bull market when cumulative net new highs are trending down and making new lows. It's normal that this particular measure would be making new highs with the market if we're in a bull market. That's not the case. And so, in fact, we're orders of magnitude away from making a new high in cumulative net new highs. I mean, a lot of time will have to elapse for this to change, and I don't see that changing anytime soon.
I feel like that's a chart everyone should be staring at on a daily basis because it's really quite telling. Looking at the put-call ratio, it looks like fear is subsiding. So is this a positive we can take away from this? One positive?
Yeah. So here's the thing. A lot of these measures have been distorted by the advent of 0 days to expiration option trading, right? And so, we saw this huge spike last October that was like off the charts. It was like, how do I interpret this? Well, that's because 0 DTE dramatically exaggerated what would have normally been a position of anxiety, right, for options traders, right? And so we actually didn't respond to that appropriately because we thought, well, this is wrong. We can't. This is so out of control. It's 10 times worse than it was during the great financial crisis, right? So the interpretation was distorted. Now we're kind of taking that more seriously, saying, okay, reaction should be bigger, right, because of 0 DTE, and we're not seeing that. So we did get above kind of that 0.75 level that would normally indicate, trader anxiety, right? The demand for put options. But even at 0.75, the put call ratio still favors fewer puts being bought than calls. So there's obviously net demand for calls, right? Even when you're at 0.75 or slightly higher, it's not until you get above 1.0 that demand for puts outweighs demand for calls. This just happens to be the range in which we trade and that we measure it. We peaked much lower this time, which suggests that this wasn't as fearful a stage in investor psychology, right? And then we've now rolled back over to neutral territory. Now the VIX has pulled back into the mid-teens, I think, 16.5%, somewhere around there. It had been upwards around 21, 22%. We kind of expected it to break out above that 20% and run. This pullback in the VIX doesn't take that off the table. It just suggests that we're in kind of another sharp counter trend advance. It's going to take the edge off of people's desire or demand for put options, and that's going to lower volatility and pressure the put call ratio. But I think this is just a blip, and that directionally we'll see both of those measures push much higher and possibly challenge the levels that existed a year ago, October.
So Jeff, moving away from the level side of things of the charts, ultimately, a lot of these things and a lot of investors really care about the valuation of the market. How are things looking to you from a valuation basis?
Well, this is a problem. See, valuations are historically high. We're in the 10th decile. And whenever your valuations are excessive at that level, they put a cap on the upside. Back in my Leuthold days, we did a study pioneered by Steve Leuthold back in the 60s, right? Where he would go through and look at the decile of valuation of the S&P 500 every year and keep a histogram of that. Now my friend Doug Ramsey continues that work at the Leuthold Group. And my recent conversations with Doug suggest that this 10th decile level has a projected forward 10-year compound annual growth rate of 3.25%. So, I think that's a pretty low upside potential for equity investors, considering the risk that you're taking and considering you can buy a 10-year treasury that's going to yield upwards of 4.8% today, right? So, outstripping that expected total return on equities, that's a compound annual growth rate, right, for 10 years of 3.25 by, over 1.5%. So, it's a pretty wide margin to suggest that equities should be overweighted relative to fixed income at this point.
All right, so we'll see how all that pans out, but that's been great. Jeff, thank you so much for sharing your thoughts from Alpha Insights. I love these monthly pieces.
Always a pleasure, Mehdi.
And I want to urge our viewers, make sure you check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.